Hello, my name is Alexandra Carade, and I'm an early child care business coach. In this video, we'll be discussing pay increases and payroll taxes, how to navigate the increase in costs associated with raising employee compensation. The information contained here has been prepared by Civitas Strategies Early Start and is not intended to constitute legal, tax, or financial advice. The Civitas Strategies Early Start team has used reasonable efforts in collecting, preparing, and providing this information, but does not guarantee its accuracy, completeness, adequacy, or currency. The publication and distribution of this information is not intended to create, and receipt does not constitute an attorney-client or any other advisory relationship. Reproduction of this information is expressly prohibited. Today, we'll be discussing why you should increase pay for your employees, what types of pay increases you could offer, and what those pay increases will cost you. Child care providers are experiencing an influx of funding from the Child Care Relief Fund and other state or federal avenues of support. With this increase in available funding, many child care providers may be wondering how to best utilize these much needed funds to support their business as they work to recover and stabilize through the COVID-19 pandemic. While there are a number of effective uses for relief funds that can greatly impact your business, one particular option that business owners may wish to consider is increasing rates of pay for both new and existing employees. Your employees are an asset that can greatly impact your ability to attract and retain families for your child care program. Put simply, the presence of high quality employees can help you recruit and retain new families into your care, while the presence of low quality employees can turn them away and potentially damage your reputation. Parents are seeking reputable care with reliable staff more than ever before, with a dramatic emphasis on health and safety as a top priority due to the COVID-19 pandemic. Additionally, investing in your employees may allow you to fully staff your business or even increase the number of staff you have, which can in turn safely and responsibly increase your capacity and your revenue. Investing in your employees can help you to improve the quality of care you offer to your families while also helping your business to grow. When considering increases for your employees, there are a few different types of pay increases that you may wish to consider that have different impacts on your employees and your business. Bonuses, temporary pay increases, and long-term or permanent pay increases. As a first step, determine what type of pay increase you would like to offer your employees. A bonus is a one-time lump sum payment that boosts your employees' overall income with no obligation to offer additional bonuses in the future. Bonuses can be useful in attracting new employees to your organization or to retain existing employees and reward them for their hard work. For example, you may wish to provide a bonus for a new employee upon hire or after successful employment with your organization for 6 months. You could reward employees with a bonus during times of greater need, such as before the holidays, the beginning of a summer break, or for working during evenings or other non-traditional work hours. Bonuses are also a fantastic way to reward employees for times that they have gone above and beyond in the workplace, such as during periods of being short-staffed or working in situations that are more difficult than usual and can have a great impact on employee morale. Temporary pay increase is one in which you can increase the salary or hourly wages for your employee, but it is intended to last only for a short duration of time with a clear end date. For example, you could reward your 2 hardworking employees for their efforts during the pandemic by increasing their wages over the course of the next year. These employees would understand that they would return to their original wage levels after the temporary pay increase period ends. Long-term or permanent pay increases are those that increase the salary or hourly wages of an employee permanently and is considered a raise of their base level of pay without any planned reduction. This type of increase is desirable from an employee's perspective because it means a permanent increase of funds into the foreseeable future. From an employer's standpoint, this type of pay increase can help your business remain competitive and retain employees. However, these must be sustainable on the employer's side as well. When considering raising compensation for your employees, especially if you hire new employees, it is worth evaluating your current compensation levels to avoid wage compression. Simply put, wage compression happens when employees who have been in a position for a long time earn less than new employees in the same type of position. Wage compression can happen when demand for employees exceeds the supply of employees, resulting in new hires receiving higher wages than existing employees of the same level. It is especially easy for this to happen when your criteria to determine compensation is out of date, too broad, or otherwise unclear. Wage compression can cause undesirable internal conflict between new and existing employees and can make it difficult to retain existing employees. To prevent this from happening, we recommend creating a clear pay scale to ensure that pay is fair and equitable across your organization. It is a great practice to reevaluate your pay scale in comparison to current market rates at least once per year and whenever new hires are made. One option to collect that data would be to review up to 10 job postings for similar positions from similar childcare businesses in your area to see how much they are paying. Some online job search sites also offer a convenient search function that allows you to easily search the estimated median salary by profession for your area, as well as compare those local median salaries to national rates. Your pay scale should reflect your employees' education levels, qualifications, skill levels, and experience in conjunction with the responsibilities and roles associated with their position. To begin creating a pay scale, write down all the job descriptions in your organization, key qualifications, and responsibilities associated with each role. Evaluate each position based on required qualifications or certifications, responsibilities, and then roll and rank them accordingly. Evaluate each position based on required qualifications or certifications, responsibilities, and role, and rank them accordingly. Group positions of similar ranking together in tiers. Research market rates for similar positions from similar establishments in your area to find average compensation for each tier. Create a range of pay within each tier, spanning from entry level to highly skilled. Entry level may be 75 to 80% of the market average, whereas highly skilled may be up to 125% of market average. Evaluate employees based on their skill level, seniority, and experience to determine if they should receive entry level, average, or highly skilled level pay within their tier. When considering increasing employee pay, either short-term or long-term, it is important to be aware of the associated costs so that you, as a business owner, can be prepared to cover them. To determine the increase in costs associated with raising employee pay, you will need to compare your current costs with your new costs, including both rates of pay and payroll taxes. You'll look at current wages, current payroll taxes, to determine your total current costs. You will calculate the current wages that you pay your employee each week by multiplying the total number of hours that they work per week by their total current hourly rate to find their current wages per week. Now, as an employer, you will also need to be aware of the increase in payroll taxes that comes with increased wages. Payroll taxes include Federal Insurance Contributions Act taxes, federal unemployment tax, and For the state of Texas, Texas unemployment insurance tax. You will need to combine your total wages paid to your employee with the payroll taxes owed on those wages to determine your total current costs. Let's dive into current payroll taxes more deeply. As part of FICA, there is a Social Security tax. The Social Security tax is 6.2% on the first $142,000 an employee makes in 2021. So you'd multiply an employee's wages by 6.2%, which is 0.062, to find how much Social Security tax you, the employer, are responsible for paying on those employees' wages. Another part of FICA is the Medicare tax, which is 1.45% on all an employee's wages. You'd multiply the employee's wages by 0.0145 to find how much Medicare tax that you, the employer, are responsible for. For the Federal Unemployment Tax Act, 6% is withheld on the first $7,000 an employee makes in 2021. To find 6% of an employee's wages, you'd multiply the wages by 0.06. And the Texas Unemployment Insurance Tax. The Texas Unemployment Insurance Tax requires 0.21% to be withheld on the first $9,000 an employee earns in 2021. So you'd multiply the first $9,000 annually of an employee's wages by 0.0021 to determine the Texas Unemployment Insurance Tax. You can find a pay increases and payroll taxes calculator at childcare.texas.gov. Let's dive into an example of how you would calculate current payroll costs. Let's say you have one full-time employee who works 40 hours a week that currently earns $10 per hour. We'd multiply the total number of hours the employee works per week by the current hourly rate to determine their current wages per week. So 40 hours per week times $10 per hour equals current weekly wages of $400. To calculate payroll taxes for a full-time employee paid $10 per hour, we'd multiply $400, which is their current weekly wage, by each of the taxes eligible for payroll: Social Security tax, Medicare tax, FUTA tax, and Texas UI tax, using the percentages noted in this slide and in the prior slide. For $400 weekly wages in Texas, the total taxes per week comes out to $55.44. You would then combine the total wages paid to your employee with the payroll taxes owed on those wages. $400 plus $55.44 equals $455.44. Let's say you want to raise your full-time employee's rate of pay from $10 per hour to $12 per hour. You would plug $12 per hour into that equation as the hourly rate, because that is the rate which you want to pay your employee, and multiply that by 40 hours per week to find their new amount of weekly wages, which would be $480. You already know the total weekly cost associated with paying your employee $10 per hour. So now you need to make the same calculations for payroll taxes using $12 per hour as your rate of pay. Going through all those calculations, you would find that new payroll taxes for $12 per hour at 40 hours a week equals $66.53. When you add together the weekly wages plus the payroll taxes, your new total cost in this example comes out to $546.53. So now you have the total current cost and the total new cost. To determine your total increase in weekly costs, to raise one 40-hour-a-week employee from $10 per hour to $12 per hour, you can subtract the current costs from the new costs. So in this example, we see that the increase in costs becomes $91.09. This means that the total employer costs per week increased by $91.09 when giving this employee a $2 per hour raise. To calculate the annual cost of giving an employee a $2 per hour raise, we can multiply that increase in costs by 52, which is the number of weeks in a year, to find the total annual cost. And we find that the total cost of offering one employee a $2 per hour raise is $4,736.68 per year. You can also use our payroll tax calculator to better understand the increase in costs associated with raising employee compensation. Also, feel free to set up a time for a free call with a business coach if you would like more help with this process. Now, when increasing employee pay, it is important to make sure that you are prepared to handle these costs as part of your business expenses. Whether it is for one-time lump sum bonuses or wage increases over a short period of time, you will want to make sure that you have the estimated payroll costs ready when owed. When determining how much to withhold for bonuses, know that one-time lump sums can be taxed in two ways. First, supplemental pay, and second, combining their bonus with regular pay. If you'd like to provide supplemental pay, you can calculate the taxes owed on your employee's bonus using a flat percentage of 22% for supplemental pay, regardless of your employee's income tax withholding rate. This is easiest when you pay your employee in a separate payment from their normal wages. So if you were to hypothetically offer a $1,000 bonus, that is 22% of $1,000 would be $220 in taxes. Alternatively, you can combine the bonus with regular pay. You would then treat the combined amount as if it were one payment and calculate the payroll taxes the same as you would for regular pay. So if you were combining a $1,000 bonus with a $1,200 paycheck, the combined payment would be $2,200. You'd find the payroll taxes on your new figure of $2,200 and find the total payroll taxes on the combined payment, which in this example comes out to $304.92. When calculating withholding amounts for bonuses when combined with regular pay, combine the payroll tax amounts with the federal income tax withholdings per your employee's withholding rate. Once you have determined the amount that will be owed for payroll taxes, estimate how much you will need to set aside to ensure you have funds available when the time comes. This can be as simple as taking the amount that you anticipate owing and dividing it by the time period that the wage increase will cover. To use our previous example, raising a full-time employee's pay by $2 resulted in a new weekly cost of $546.53, which equals $28,419 per year. This means that the employer would need over $2,000 per month to cover the total costs of this employee with their new salary. While this might seem like a good amount of money in total, like a lot of money, the increase was $394.71 per month, which equates to a 17% increase. In this case, you would need to plan to set aside at least an additional $394.71 each month to ensure that you are able to cover those additional costs. Resources are available to help you learn how to go through these steps, as well as how to create a monthly budget, determine your cash flow, make sure you are paying yourself, consider adjustment in rates. You can access these resources at childcare.texas.gov or review them one-on-one with a business coach. These steps will help you to create a solid financial plan to ensure that your business remains viable into the future and allows you to create a plan to sustain increases in employee pay. If you have any questions, do not hesitate to request a business coach or contact coaching@ecebizcoach.org for more assistance. Be sure to visit childcare.texas.gov to find all those resources that I just described and access free business coaching.